So private debt's actually a very, very large part of the Australian investment market. The private debt market in Australia is a little over $3 trillion. It's actually dominated by the commercial banks in the country. They have about 90% of the market share. Offshore, that number is in the mid-20s through to the 30s odd percent. So in Australia, the market is dominated much more by the four major banks than it is in offshore market, where non-bank lenders are a much larger percentage. Private debt is really lending a company, an asset owner, an individual money to perform certain business or commercial purposes. And that can vary from real estate owners through to industrial companies, basically the broad array of businesses and asset owners that make up the economy. Where we focus within that is what we call opportunistic debt. So it's finding counterparties who have a requirement for capital. We structure it in a senior secured manner so that we're achieving for our clients a much more attractive risk-return characteristic than they would than having it just in term deposits, and even than they would just having it in plain vanilla equities. A good deal for us is one where we have zero chance of losing money. So that comes down to margin of safety. Ultimately, the opposite of that is a deal that we seek to avoid, is where we don't have absolute certainty going into the deal that we're going to get a return of our capital and a return on our capital. Both things are very, very important. And in the history of the business, we're yet to lose money on a single deal, and we want to continue that for our investors. And ultimately, quality of counterparty is a key thing that we consider. The quality of the assets that we're securing, the quality of the cash flow streams, the quality of the management, the quality of the industry. And then ultimately, if those things don't stack up in a manner where we have supreme confidence about the counterparty quality, we won't do it. And there's an array of examples that might mitigate that, but ultimately quality for us is the key thing that we're looking for in all circumstances. At Realside, we focus on a number of different investment strategies. One of those areas that we focus on is opportunistic debt or credit investment. The new Realside Capital Opportunities Fund is a continuation of what the team's been doing for many, many years. And it's a diversified portfolio of primarily senior secured investments. It's aimed to generate, in this current market environment, north of 10% return. That's very consistent with the track record that we've generated for many, many years. It's going to be a diversified portfolio of 30 plus investments, and we're trying to build an array of different debt investments that through the market cycle will generate consistent returns and provide for our clients really a return and income stream which exceeds equity markets with close to zero volatility. First and foremost, we're there not to lose money. We're there to make low double-digit returns consistently. Obviously, you're adding a lot of value for your clients, but doing that without the risk or concern of capital loss is our key objective. I talked a moment ago about quality, and our process is assiduous. It's very detailed. It's akin to a private equity company in terms of the full due diligence they would go about in buying an asset or a company. It's very, very detailed in this documentation. It's a very, very detailed utilisation of consultants and industry specialists in areas to augment our research. And ultimately, the value that's provided through that is a very, very deep conviction around our counterparties' credit quality and their ongoing viability, such that when we loan them that money, we have a very, very high degree of confidence that we're going to earn the rate of return that is stipulated in the loan documentation. And that's very consistent with the track record the team's had over a very long period of time.